Welcome to today's Explainer. I am absolutely thrilled to be your guide today because we are going to completely demystify the stock market. If you've ever felt like investing is this super exclusive, hyper-complicated world where you literally need a finance PhD just to get by, I want you to take a deep breath. Today, we're breaking the whole thing down using an analogy we all understand: cooking a great meal. By the end of this Explainer, you're going to have the exact recipe you need to confidently cook up a secure financial future.
To get us there, here's our menu for the day. First up, the zero-sum investing game. Second, what is passive investing? Third, the three-fund portfolio recipe. Fourth, target date funds on autopilot. Fifth, the hidden drag of costs. And finally, number 6, overcoming analysis paralysis.
Okay, let's dive into Section 1, the zero-sum investing game, understanding the market. Before we can start mixing up our ingredients, we really need to understand the basic rules of the kitchen we're standing in.
So, I want you to ask yourself a quick question. Does investing actually have to be complicated to be successful? Think about how Wall Street is always portrayed in the movies, right? It's fast-paced, it's incredibly stressful, there are guys yelling over phones in front of a dozen screens trying to pick the next big winner. It creates this totally intimidating myth that unless you're a genius analyzing data around the clock, you're going to lose. But is that really true?
Well, not according to Jack Bogle. He was the legendary founder of Vanguard and the pioneer of the index fund. And he fundamentally believed and practically mathematically proved that simplicity is the master key to financial success. You really don't need complexity to get great returns. Actually, as we'll see, complexity is usually the exact thing that ruins a perfectly good meal. To really get why simplicity wins, we kind of have to look at the math behind the market. Research from Vanguard points out that the stock market operates as a zero-sum gain before costs. Just think of the total stock market as a giant pie that's being shared by absolutely everyone. The total return of the market is just the average return of all the people participating in it. Because of this absolute mathematical reality, if an active manager wants to carve out a bigger slice of that pie and beat the market average, well, someone else mathematically has to get a smaller slice and lose. For every outperforming winner, there literally must be an equal underperforming loser. Since trying to outsmart millions of people to get a bigger slice is statistically brutal, let's move right to Section 2. What is passive investing? Buying the haystack. This brings us right to the core philosophy of our recipe: passive management. See, passive investing doesn't try to beat the market, it simply aims to be the market. Instead of constantly buying and selling, desperately searching for the needle in the haystack, that one winning stock, passive investors just buy the entire haystack. You buy a fund that holds a tiny piece of every single company in a market-weighted index. That way, you're guaranteed to capture the overall growth of the entire market over time.
And this approach has actually cultivated an entire community of what they proudly call lazy investors. Their philosophy is wonderfully boring. You buy broad market indexes, you hold them for the long term, and we're talking decades here. You pay the absolute lowest fees possible, and you stay the course no matter what the scary news headlines are screaming. It's about getting maximum results with minimal daily effort.
So what exactly are we throwing in the pot? Let's check out Section 3, the three-fund portfolio recipe, and your core ingredients. To own a piece of essentially the entire global economy, you really only need a standard three-fund portfolio split. First, a total U.S. equity fund. This gives you a slice of roughly 4,000 publicly traded U.S. companies, from massive ones like Apple all the way down to smaller regional banks. Second, a total international equity fund. This grabs thousands of companies outside the U.S., like Samsung or Nestle. And third, a total U.S. bond fund, to provide some much-needed stability. Seriously, with just these three funds, your kitchen is fully stocked. But you might be wondering, how much of each ingredient should you actually use? Well, that depends entirely on your own stomach for risk. Just look at this historical data from 1926 to 2012. It shows that if you went 100% into stocks, you got a phenomenal average return of 10%. But in the worst year, your portfolio would have dropped by 43%. Just imagine that happening the year before you retire. On the flip side, going 100% into bonds limited your worst drop to just 8%. But your average return was nearly sliced in half, down to 5.5%. You just have to choose a balance between stocks and bonds that lets you sleep peacefully at night while still growing your wealth. Let's move on and see how this builds in Section 4. Target date funds on autopilot, the microwave dinner. Because what if you don't want to measure out the ingredients yourself? Well, that is exactly where target date funds come in. If the DIY 3-fund portfolio is a home-cooked meal where you control all the ingredients and the exact spice level, a target date fund is a super high-quality, pre-packaged microwave dinner. You literally just pick the year you want to retire, and the fund handles the rest. It buys those exact same broad market index funds we just talked about, and as you get older, it automatically shifts your money from riskier stocks into safer bonds. It's essentially a poor man's financial advisor. The DIY route definitely gives you more control over taxes and risk, but a target date fund gives you forced discipline and just ultimate convenience.
All right, now that we've got our ingredients sorted, we have to talk about Section 5, the hidden drag of costs. This is absolutely the secret sauce to making our recipe work. Now, what's really interesting about this visual from Vanguard is how it exposes the silent killer of wealth. Remember that zero-sum game we talked about, where the average returns sit right in the middle? Well, investing isn't free. You still have to pay fees to the people managing those funds. When you introduce high costs, your return curve actually shifts to the left. The more you pay in fees, the further left you go, meaning your personal returns drop way below the market average. Basically, high fees turn a zero-sum game into a losing game. Every single dollar you pay in a fee is a dollar that isn't compounding for your retirement. To put that into perspective and show just how devastating those costs are, look at this staggering number. According to the S&P indices versus active scorecard, in 2021, 79% of highly paid active professional fund managers actually underperformed the simple S&P 500 index. And honestly, when you zoom out to a 10-year period, the numbers are even worse for the pros. The math clearly shows that by simply buying a low-cost, passive index fund and being quote-unquote average, you actually end up beating the vast majority of active professionals over the long run.
So, we have the recipe, we have our ingredients, and we know the secret sauce. But there is one final hurdle for beginners. Let's look at Section 6, Overcoming Analysis Paralysis, and why you must just get started.
You see, analysis paralysis is that overwhelming fear of making a mistake. You might be sitting there thinking, okay, should I do the DIY 3-fund portfolio? Or should I just use a target date fund? Wait, what exact percentage of international stocks should I hold? Here is the absolute truth. The difference between a DIY strategy and a target date fund is completely irrelevant compared to the massive danger of not investing at all. Action beats perfection every single time. Getting real money into the market focuses your attention. You can always adjust the recipe later, but you have to actually turn the stove on.
So what does this all mean for you? It comes down to this. Will you let analysis paralysis keep you from cooking up your financial future, or will you take the first simple step today? Remember, simplicity is your master key here. You've got the recipe. It is time to get cooking. Thanks so much for joining me on this explainer, and I absolutely can't wait to see what you build.